We will continue with the second part of our podcast. Those who believe in the efficient market hypothesis say that the market is efficient and therefore you should not try to outperform it. However, legendary investor Larry Swedrow says that you can sin a little and overweight a little bit those higher expected returns assets such as emerging markets. From a top-down approach, when constructing a strategic asset allocation, which would you consider the best percentage one should allocate to EM equities, given that the market cap weighted indices currently allocate about 12% or 1/8 to EM?
Yeah, so in terms of the efficient market hypothesis, I mean, it's obvious it's difficult to beat the markets, but what you can do is try to own as many different asset classes that you can. Try to find asset classes that perform differently, that are not completely correlated, and that certainly will reduce your risk, right? So if you can buy emerging markets and you expect the returns to be similar to the U.S. market, over your time frame, and the correlation is not 100, then you benefit from that, right? So the difficulty about that is arriving at that opinion that the return profile is the same. But under certain circumstances, you can have the opinion that the U.S. market is very expensive and emerging markets is very cheap. And then you have no excuse sort of to allocate to an asset class that has low correlation and that should improve your return profile. So I think it's not just emerging markets. It's any kind of different cash flow stream that you can identify that you believe has an acceptable return profile and is not correlated to your main home market, market, then you should take advantage of that. So absolutely. Now, what allocation should you have? I guess that would depend, based on the return opportunity. So when markets are cheap, you would want to own more than when they're expensive. So you do have to keep in mind the valuation. Generally, I've in my global allocation portfolios, I've sought to keep about 10% in emerging markets and to allow that to appreciate, when the markets are doing well. I must say that currently I'm actually a bit below that level, but I'm still maintaining some allocation to emerging markets. So I currently, there's no easy formula for doing any of this because market conditions constantly change. And it's been my opinion that in general, markets everywhere are expensive. And that we were living, with negative interest rates around the world and asset bubbles almost everywhere. And so under these kind of conditions, it was not going to be easy to make money. And then one of the things you could do to at least try to lose less money is to have some defensive sort of anti-bubble kind of assets. I don't think emerging markets falls into that, but I think some of the commodities investments have fallen into that, particularly energy investments, and things like gold also are an important part of that. And as the markets go down, then I think once again, then you'd want to increase your allocation to these more aggressive kind of investments. But I think in general terms, maintaining about 10% of your allocation to emerging markets seems like a reasonable position to have.
Yeah, I think I'm a little bit overweight with about 90% in emerging markets.
That yes.
But I'm more in Jeremy Grantham's camp. I believe that almost everything is a bubble, and I think EM equities, although they have negative momentum right now, are less in a bubble. So if you have 10, 20 years ahead and you don't care that much about volatility, you should do fine. Although they have that negative co-skewness that might affect your portfolio,
Yeah.
like it also happened, I think, in 1945 or something like that, when Chinese markets were closed. Japanese equities lost 97% of their value. Now we see again
Sure.
Russian equities losing almost 100%, at least in London Stock Exchange. But if you look at MOEX, on their market, they are trading 100 times higher because you cannot do any arbitrage because
Yeah.
investors don't have access to the other markets. So pretty incredible situation. I haven't seen anything like this before.
Yeah. Yeah. Well, you have more guts than I have.
I'm younger.
I'm always very concerned with managing risk, and in certain, I put emerging markets in more in the higher risk profile, and my experience in 30 years in investing in emerging markets, I have become much more opportunistic now than I was in the past. So I had, perhaps a similar view to yours. I used to have that, I'd be happy just holding on to these stocks for the long term. But my experiences has shown me that this is very painful. I mean, some of these blue chip stocks in bad markets, they cannot do anything for very long periods of time. Particularly if you bought them at high valuations. So I don't have anything against doing that. I think that's fine. Though 20, 30 years is a long time. But I prefer to have like a shorter time horizon in emerging markets, perhaps like 5 years or so. I think your great opportunities usually play out in about 5 years. If you can find a good entry point and a good exit point. The great opportunities, the multi-baggers, the 5 times your money kind of returns, they usually play out in that time frame. And that's been my experience, and that's why I focus on that.
Speaking about emerging markets, in a paper called Emerging Market Portfolio Strategies, Investment Performance, Transaction Cost, and Liquidity Risk, Italian researchers Roberto Violi and Enrico Camerini have found that there is a significant benefit to including EM assets in a globally diversified portfolio. They also found that country factors still dominate cross-country valuations, while high country-specific volatility can be diversified away, and a diversified basket of EM equities is not necessarily riskier than a developed market one, and the high individual country volatility and country factors create potentially useful investment opportunities for active asset managers. All in all, they consider EM have higher risk than most developed markets and therefore continue to command higher expected returns. However, when analyzing tail risk, they found MSCI World had the same skewness, minus 0.6, as MSCI emerging markets with a slightly higher kurtosis for EM. Do you think that global emerging markets are a source of idiosyncratic risk or only systemic? Because I've heard other opinions as well that you should take into account that emerging markets have also higher, let's say, skewness risk.
Um, no, I mean, I don't. I think they're just one asset class. They're, and it's very difficult to generalize. I mean, there's all sorts of different. Each country is really different. Um, I think the biggest risk is really the biggest risk is the event risk. The Russian Revolution, 1917, Japanese market, 1940. During the Second World War, the Russian situation today, but the Chinese situation today, where you have a government that's really anti investing. Um, those are the biggest risks, right? And how does one manage that? I mean, it's not easy, because that's that's political science, right? So, but you can't neglect that. So, for example, in China, I have gone from being quite bullish, 10 years ago, to increasingly bearish on this market. And that's purely for political reasons, because I've come to believe that the market is being driven by politics. Now, what's driving China today is a political agenda, right? It's not an economic agenda. So that makes it very difficult for an investor, to believe in the market. So those are the kind of things you really have to pay attention to. So they're much more present in these markets that are politically unstable often. And every market has a different degree of instability, and you have to be very cautious with that. So you have to have a strong opinion on where you see Indian democracy going, or the political system, or India currently has a very well-defined sort of market economy with the role of the government and the role of the major companies. It's a very friendly environment for the billionaires in India. So when you invest in India, you have to have a strong opinion that this will persist. And that's a key part to your investment decision. And so every country is like that. I mean, it's just much more complicated when you're dealing with 30 countries and you have to analyze that. People don't have the time for that. So Vietnam is another interesting situation, because I've liked Vietnam, but it's a communist regime. I've liked the Vietnamese market, but it's a communist regime. In many ways, they follow the Chinese path, and that's not been positive for investors in China. So I have to ask myself, how much do I want to allocate to Vietnam? The macro story is very good, but the political regime is unpredictable. So for every country, you have to take these decisions. So that it's complicated, and it got very complicated when China became like 50% of emerging markets. And basically, it's like, if you could diversify this over all the different markets, and every market was 3-4%, then you wouldn't worry about it so much. Uh-huh. But when you had one market become about half, and you have such a big turn in the investment friendliness of the market, well, you really have to worry about that. So that's why I think I believe you have to be very hands-on, very, very nimble. I mean, things change pretty quickly, and you have to pay attention to that. So maybe it's not a market for amateurs, but I don't think any market's a market for amateurs. But But you have to be willing to, to spend time understanding the politics and having an opinion on them, right? It's like, but most people can't be expected to have an opinion on Vietnamese politics. They're just not going to have it. But I think you have to. If you're gonna allocate to these markets, you better have an opinion on these. You better know what you're investing in. So, for example, like Brazil's an interesting situation because it's a big market. There's an election coming up today, and so you have to have an opinion on, like, what are the possible factors from that? What are the possible impact from this election and so forth. And I think in general in Latin America, I think it's relatively more stable, and I think Brazil is relatively more stable. So I'm not too concerned about the election in Brazil. But the one thing that may happen is you may have like a contested election, with significant chaos, and my personal view is that things will be okay in Brazil, and I would take advantage from that. I would take advantage of any kind of of a tumultuous kind of election. So you have to know what you're investing in. And I've been doing this for 30 years, and I feel I have a good grip on it. But I mean, it's not easy. I mean, I know some guys that are like very good investors and are very concerned with the macro, everything I'm talking about, and they blew up completely with this Russian thing, completely, right? And they're completely aware of. I'm not going to name any names here, but like one fund, which is like its whole focus is on avoiding risky situations, had like enormous overweight in Russia. So it's not easy, right?
I think GMO too had about 14% of one of their emerging market value or something like that.
I know GMO was heavily invested in emerging markets.
Me too.
and in Russia, and GMO is an interesting example because one of my favorite papers on emerging markets. If you don't have it, I'll send it to you. But it's a GMO study on how you avoid like risk in emerging markets, how you avoid political risk and so forth. And they described their entire model, and somehow it did not pick up Russia. I don't know why, right? But so it's not easy, and you got to be properly diversified, and you got to buy cheap. That's what I believe in. So I look for those really, really cheap opportunities, and I look to really, really consider risk very, very carefully. I'm extremely aware of different risks, and so.
Once emerging markets become more integrated within the global financial markets, their diversification benefits might decrease due to increased correlations. How do you see the evolution of EM asset correlations from a globalization, deglobalization perspective?
Yeah, so the correlations, particularly short-term correlations, have increased dramatically, right? And I understand why. It's because of these, the way Wall Street runs now are these enormous shops, enormous investment houses, a lot of which are trading, second by second, and they're arbitraging the entire world. So these are the Renaissances, the Bridgewaters, all these funds that are enormous, and they have their machines, artificial intelligence driven machines or whatever, and they trade every time frame. So I mean, they trade from 1 second to decades. So that leads to, I think, much more short-term correlation. And you see that in the data, right? The emerging market MSCI EM has become much more correlated on a daily basis or weekly basis. with the S&P 500 than it used to be. Now, for me, that when I take positions, I'm thinking more in terms of, multi-year, periods, 2 years to 5, 6, 7 years. And then this sort of short-term correlation is irrelevant. I still think over these longer periods, when you look at months and years, the correlation is much, much less. It's still an attractive, it's higher than it used to be, but it's still a very attractive, low correlation from a building a portfolio's point of view. So it doesn't really worry me. Now, the good thing about China sort of going its own way, and the decoupling of China from the U.S. economy, but I also think from financial markets. I think you'll get a significant decoupling of China from the U.S. financial market. That could create lower correlation. So that could actually be a positive. So if China gets cheap enough and the correlations are very low, and you get signs of perhaps a change in the government there towards more investor friendly, you could have a market with very good opportunities with lower correlation, and that could be very attractive in the future.
Which is your view on China A shares equities? They have higher realized volatility but lower correlation to global stock market indices. I think about 0.32. Ray Dalio is a huge fan of uncorrelated return streams. Do you think China's A shares are a good portfolio diversifier?
Yes. So the China A shares are a much, much better diversifier than the MSCI China. And they've provided much better returns over the past couple of years. And that's because all the big investors were essentially invested in the New York listed tech stocks. So that may not persist because now the New York listed stocks have all collapsed. But it's a different profile. It will continue to be a different profile of companies. And it provides lower correlation, which is quite attractive. And so, yeah, I've had most of my investments in China have been through like local vehicles, the A shares, the CNEX index, and so forth. And I think they were cheaper, and they have lower correlation. So in both regards, they're attractive.
Which individual EM countries do you believe might be facing the famous Dutch disease?
Well, so obviously the commodity producers,
Brazil.
Right? So yeah, Brazil is the worst. I am very pessimistic in that regard. In Brazil, they've always been they've really historically always, whatever part of Brazilian history you look at, the economy has been driven by commodities, and that's only gotten worse. That's only gotten worse in recent years. The 2008 crisis has just been terrible for Brazil, much worse than other countries, in big part to a Dutch disease kind of phenomenon. They dramatically overvalued their currency. They they did all the crazy things that countries do when they get these windfalls from commodities. And as you know, the Dutch disease comes from the experience of Holland in the 1970s when they discovered gas fields, and that led to more fiscal spending and current account deficits and so forth. And that's where we get the term Dutch disease from. And in Brazil in the early 2000s, they discovered these large oil fields, really the largest discovery of oil probably over the past 30 years or so has been the Brazilian offshore oil fields. And that created like just a wave of optimism and illusions of grandeur, and at the same time, you had the rise in commodity prices that took place because of the impact of China on the markets. And the combination of these two things has just created havoc for the Brazilian economy and has led to a massive deindustrialization and really an economy that doesn't grow now for the past 10 years. I mean, it's really, really, and it's not getting better. It's not getting better. So I actually, when you see like the current increase in commodity prices, and people think like this is a reason to be optimistic about Brazil, but I don't know. What they really need to do is get back to work and become more productive and invest more in. They need to rebuild their industry. A country like Brazil cannot afford to have deindustrialized the way that they have. So yeah, Dutch disease is alive and well. I mean, the biggest Dutch disease right now, I think, may be in the U.S. because the U.S. I mean, not only do they have the sort of the extravagant burden of the reserve currency, which forces them to have current account deficits for now a 40-year period of current account deficits in the U.S. But at the same time, you had in some regards, the U.S. is also deindustrializing very rapidly. It has over the past decades, and the U.S. is a big commodity producer. I mean, if you look, everything that we sell to China is just commodities. That's the only thing they buy from the U.S. Soybeans and corn and so forth. And then over the past 10 years, you've had this incredible increase in oil production, oil and gas production in the U.S. from the shale basins in Texas and Oklahoma and so forth, which has completely revolutionized the energy business in the U.S. and made the U.S. into the largest importer of energy to right now an exporter of energy, with the prospects of increasing gas exports to Europe in coming years. And so this is it's going to leading to a stronger currency. It's probably going to overvalue the dollar even more, deindustrialize even more, and that's Dutch disease, right? It's these are things that countries like Germany and Japan and China don't need to worry about.
Which is your expected rate of return and volatility for EM equities in the following decade?
Well, you can get that from my model there, but I think it's reasonable to over the next 10 years to expect 8% or so, 8% in 7-8% in real terms, so before inflation. So this is my expectation for the U.S. market is much lower. It's like 1 or 2%. So the expected returns, assuming that things go back to normal with normal cycles and a weaker dollar, expected returns in emerging markets are quite good. And for a country like Turkey, I would expect 14-15% annualized real returns because the stock market is so cheap, the currency is so cheap, and historically Turkey's gotten back on track. You just have to wait for the economy to get back on track.
Looking only at the mean and variance of an asset's contribution to a portfolio assumes that the returns follow a normal distribution, ignoring an important statistical measure called skewness. We can think about this as disaster risk. For instance, investors who had exposure on Russia have been facing idiosyncratic risk due to the current war in Ukraine and lost all of their investments due to unexpected returns despite high expected returns for Russian equities. Right now, Russian ADRs are worth zero and trading has been suspended. There are even rumors of them being delisted from international bourses. These stocks might recover in time, and they already are. If we look at MOEX Stock Exchange, where they trade 100 times higher than they were trading in London, but international investors might not be able to see those returns if they face forced liquidation risk. What do you think will happen to those who had exposure to Russian ADR stocks using BlackRock's umbrella, and how to handle this disaster risk?
I mean, that's a very difficult question to answer. I mean, if I could, I would buy some Russian stocks today. But I mean, we can't even do that in the U.S. But I would definitely allocate, some capital to the hope that things go back to normal in one way or another in Russia. So I would say there's a probability that you have to think about this in probability terms, right? You say, yeah, I could lose all my money. There's a probability, maybe 20% you lose all your money in Russia if you put new money to work today. But I think there's a much higher probability, maybe 50% or so, that sometime over the next 10 years, things more or less go back to normal in Russia. So I think that's a good bet. So I would allocate money to Russia today if I could. But, these are all long-term probability bets, which, they're very difficult to make. You don't want to put a big chunk of your capital into these kind of bets, but to put in to have a small part of your portfolio allocated to these very high return kind of opportunities, I think is worth doing. I don't think I would put much more than 1 or 2% of my portfolio in these kind of bets, but I think there's a role for that for some exposure to those kind of bets.
Many emerging markets are expected to have higher economic growth rates than their developed market peers, such as, for instance, China, India, or even frontier market Vietnam. Many investors consider that economic growth and investment returns are positively correlated. However, in the 2014 Credit Suisse Investment Returns Yearbook, Elroy Dinson, Paul Marsh, and Mike Staunton have found a cross-sectional correlation of negative 0.29 between real equity returns and real per capita GDP growth for 21 countries with continuous stock market histories from 1900 to 2013. In a 2012 paper titled Is Economic Growth Good for Investors?, Jay Ritter found similar results for 19 primarily developed markets from 1900 through 2011 with a negative cross-sectional correlation of 0.39. Ritter also looked at a sample of 15 emerging markets countries for the 24-year period from 1988 through 2011, including Brazil, Russia, India, and China, and found a similarly negative cross-sectional correlation of negative 0.41. This evidence suggests that countries with strong economic growth have historically had lower stock market returns, such as the case of China, where returns were flat for 20 years almost. Given this, which are your views on how other macroeconomic indicators might influence equity returns, such as, for instance, population growth rates or debt to GDP ratio?
Yeah, I mean, I agree with what you're saying. There's no evidence really that high economic growth leads to high returns. China is the best example of that. It's the quality of that growth that matters. It's which segments, which actors in the economy are doing that growth that matters. So in China, it's all state companies that really their only shareholder that's important is the government. They don't work for minority shareholders. So that's typically the case of state companies across emerging markets. It's the case in Vietnam, where most of the companies are state companies. It's always been the case in Brazil, where state companies provide very poor returns for investors. So, and then, you mentioned Dutch disease. Well, Dutch disease is the perfect example of, why this kind of high volatility in emerging markets doesn't work. The high economic volatility. So if you're averaging 4% a year, but that means growing at 8-12% and then having negative years, it's not that good actually. It's actually not good for financial returns. So the ideal thing is that you're much better off if you have stable 2.5-3% growth than if you have completely unstable 5% growth, because that just creates havoc for corporate planning and management and financing. And so you don't need high growth for success. I mean, you look at developed economies from the time of the Industrial Revolution, from the 1850s till today, they've not grown at very high rates. They've grown at 3%, 2.5%, 3%, and that's what it requires really to build wealth over time. So, like I teach a class. I teach at NYU Stern. I've taught Chinese students. NYU has a campus in Shanghai, and I've taught their students several times. And so we talk about the Chinese growth being overstated and coming down, pretty dramatically in recent years. So my view is actually Chinese growth really properly measured is much closer to 2.5-3% than the 5-6% that the government states. But what I tell the students is that that's actually not a bad level. If you can manage 3% growth on a stable basis, for the next 20 years, that's fantastic. And then if you have a corporate sector that's dominated by private companies that are productive, efficient, and efficient with their capital allocation, but that's fantastic. That's really what matters. What you really want for successful investing is a stable macroeconomy, stable, reasonably high stable growth, 3% is great, and a corporate sector that is productive and cares about investors. If you have those combinations, you don't need anything more. So I don't really know who has that in emerging markets right now. I mean, the U.S. has been very fortunate to have very very good corporate governance and probably too much focus on investor returns in recent years. You can go to the other extreme and focus too much on that. So, but we need more markets in emerging markets to look more like the U.S., right? Low stable growth and a focus on productivity. And countries like Brazil or all these commodity producers, they should be much more concerned about maintaining stability and not always falling into these boom to bust traps.